Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. Let's get across what we saw overnight. Global stocks slipping to begin the week with little market moving news to trade on. On Wall Street, the main indices finishing in the red with investors waiting on a raft of economic data later this week. Now, stocks, specifically shares of chipmaker Nvidia, rose as it unveiled a new family of open source AI models that it says will be faster, cheaper and smarter than its previous offerings. Tesla gained after Chief Executive Elon Musk said it was testing its robo-taxis without safety monitors in the front passenger seat, while Ford is taking a $19.5 billion write-down and scrapping several EV models as it retreats from battery-powered vehicles in response to the Trump administration's policies and weakening EV demand. Ride-hailing and delivery platform Uber fell after 21 states filed a complaint against it for allegedly deceptive billing and cancellation practices. ServiceNow tumbled following a report that the cybersecurity company is in advanced talks to buy startup Armis. And iRobot shares plummeted after the vacuum cleaner maker filed for bankruptcy protection. Shares of space company Rocket Lab initially rose and then fell after launching its first dedicated mission for Japan Aerospace Exploration Agency. And gold and silver miners were mostly higher on a softer US dollar and rate cut expectations. Well, the Nasdaq is aiming at moving to round-the-clock trading by the second half of next year, home to the world's largest tech companies. The exchange operator is planning to submit paperwork with the US Securities and Exchange Commission to roll out 24-hour trading of stocks 5 days a week as it looks to capitalise on global demand for US equities. Investor demand for non-stop trading in the US has surged in recent years, prompting regulators to introduce new rules and proposals from major exchanges to enable trading beyond normal market hours. And in fact, we've seen that the New York Stock Exchange and CBOE have also recently announced plans to move to round-the-clock trading of stocks. Now, in the latest US economic data, the Empire State Manufacturing Survey Index fell into contraction, while the Home Builder Sentiment Survey rose to an 8-month high, benefiting from the drop in mortgage rates. And in the latest Fed speak, John Williams said monetary policy is well positioned for 2026, saying the FOMC has moved the modestly restrictive stance of monetary policy toward neutral, while noted Dove Stephen Myron has said the policy is too restrictive and that phantom inflation is distorting the US central bank's decision-making and causing it to keep interest rates too high, saying keeping policy unnecessarily tight would lead to job losses. Well, US Treasury yields dipped as investors waited on that jobs and inflation data later this week. The yield on the 2-year falling to 3.5%, the 10-year around 4.17%, and the US dollar index down slightly, the Aussie trading at 66.4 US cents. And in commodities, oil prices dipping as investors consider oversupply concerns. Brent crude down 1% to $60 a barrel. Copper up 1%. Iron ore little change at around 104 a tonne. And gold paired early gains with spot gold trading at around $4,300 an ounce. And Bitcoin falling to a 2-week low at around 86,000. Let's get across what's moving on US markets. Steve Sosnick joining us from Interactive Brokers. Steve, welcome back. Good to catch up with you. So, of course, we're moving quickly towards Christmas and that festive break. How are traders and investors playing this at the moment? As I mentioned, certainly waiting on that data later this week.
Well, good morning, Andrew. Traders and investors are today was very much a watch and wait mode because we know we're getting jobs data tomorrow, and that's always a big catalyst. Right now, it's a little tricky to know what to expect from the number because it's backward looking. The published estimate is somewhere around 50,000. The whisper number is somewhere around 15,000. Also a number that's too good is probably problematic because it means the Fed's not going to cut rates. A number that's on the bad side is probably taken as good news because it means the Fed might cut rates. But of course, if the number's truly bad, well, then, that leads to recession concerns. So, it's this weird melange of how to view it. I think you've got, as you know, it's the final full trading week of the year. We have a major expiration on Friday. Quarterly expirations just before the end of the year can get a little messy, but I don't see a need for it. And then, so I guess data dependency is really the key between the jobs numbers tomorrow and some inflation numbers later in the week.
Now, also a consideration for investors is how the Fed is, how it's going to be comprised next year. Just before I get to that, in fact, let's just stay on stocks. I was just mentioning there, Steve, the Nasdaq, the latest exchange to apply for 24-hour trading. What do you make of that? I mean, it looks as though it's inevitable. What is that likely to do in terms of trade volumes and the flows that you're going to see across the course of a week?
Well, remember here that they're playing catch up to a certain extent. There is an ability now for investors around the world, particularly in your time zone, to start trading stocks during local hours. We operate an ATS, an alternative trading system, out of Hong Kong, and the volumes have been increasing there. There are others that do it as well. And so what happens is we're seeing volume. There's an interest in from around the world, particularly Asian customers, to trade U.S. stocks during local hours. And Nasdaq, the NYSE, the CBOE are responding to what they see is a demand from customers. And it does seem sort of inevitable. Also, remember a lot of the younger market participants who started trading crypto first, they're used to 24/7. I don't know that there's a great rush to go 24/7, but 23/5 seems pretty realistic at this point.
Yeah, all right. As you point out, certainly those new investors thinking, why wouldn't you be able to trade 24 hours a day? Nonetheless, that's the reality we have at the moment. Now, Steve, to that point of the Fed, and I see essentially this has come down to a two-horse race of the Kevins. How's this playing?
Yeah, I think the market was given a little bit of a surprise when President Trump said to the Wall Street Journal that, in fact, implying that Kevin Warsh, not Kevin Hassett, was the new front runner in the Fed chair horse race, or shall we call it the Apprentice Fed chair edition. Certainly Kevin Hassett had been as much as a 90%, call it 90% chance of him taking the job. It had slipped to about 75% when it hadn't happened as quickly as people thought. But as of today, that number had slipped somewhere about 47%, with Kevin Warsh going from about 10 or 15% up to the 40s as well. So it really is a two-horse race. The rationale supposedly is that people close to the president sort of said, Hassett is a little too eager to please, and might actually not have the confidence of the markets, whereas Kevin Warsh might have a bit more of an independent streak in him. Ultimately, though, I don't know what to make of this, other than to say that we have a president who literally understands how reality shows work better than almost anybody. And certainly, if you want to create excitement, if you want to get people talking about that, and maybe talking a little bit less about some other inconvenient political topics, this is a great way to do it by introducing, some uncertainty into this. And certainly everybody here is talking about this in the markets. And the bond market reacted reasonably well. You showed before how 10-year yields had slipped a little bit. I think it had been rising because of fears that Kevin Hassett would push a bit more toward the president's goal of cutting rates, sort of damn the torpedoes aspect about cutting rates. And so that could incite inflation fears. You have seen the yield curve steepen a little, but it's not clear that the market is fully buying into this, but I think they're hedging their bets in terms of who the new Fed chair might be.
Well, to your point, I guess, in terms of President Trump, what's a reality show without the drama? That'd be fairly boring, wouldn't it, Steve? All right, so look, let's get back to equities then, because I do note a number of majors over your way are predicting double-digit returns on the stock market next year. Do you think that is overly optimistic or not?
I am literally the only person I know of not predicting high single-digit to double-digit returns for the U.S. stock market. Now, some of this comes from my years as a market maker, the risk manager of a big market making operation that generally worked pretty well. And my job was to think about what could go wrong in our model and what in the world could make our model go wrong. So maybe I'm a little more attuned than most, but there's a couple things that really leap out at me. Number one, midterm election years have not been good to the market recently. We 3 of the last 6 have been lower. The last 2 bear markets, which were really the only 2 significant down years of the last 15, occurred in midterm election years, 2022 and 2018. So that track record is not great. Second thing to think about is markets tend to test new Fed chairs. It's just uncanny. I mean, Powell took office in February of 2018. That was literally right around the time of the Volmageddon move. And 2018, as I just pointed out, was not a great year for markets. Janet Yellen had a little easier time of it in 2014, 2015. Ben Bernanke, 2006, got there pretty much just in time for the global financial crisis. Before him was Alan Greenspan, who took office in August of 87, just in time for the stock market to crash in October 87. I'm not predicting the sort of dire outcomes that accompanied certainly Greenspan or Bernanke, but it's just it's one of those things that something often happens. And the final part of it is the AI trade seems to be losing a little steam. Right now, it's been pretty good. It's been a bit of a rotation, but I think it's sort of too big not to succeed. And if you start to see money really coming out of the big mega cap tech stocks, because of their weight in major indices, they provide a real headwind. And we're definitely seeing a reassessment of the, I'm going to call it the profitability of the trade, the bottom line outcome, not of the idea of is AI everything it's cracked up to be. You and I have discussed this, and we've said, we've discussed this several times and said, you can have a groundbreaking technology, but you could also be ahead of yourself in the stock market. And to that example, 2022 we literally saw the top tick for the S&P 500 on the first trading day of the year. The Nasdaq hit a high about 6 weeks earlier. We're sort of shaping up with that pattern now, where we had a new high in the S&P 500 just last week, and Nasdaq did not participate. So that's another warning thing. Does it mean they all come to pass? I hope not. But these are the things that nag at me. Plus, there's just the general consensus that everybody thinks we're going up again. And when markets have a nasty way of making consensus look silly from time to time. So that's the reason for my caution, which definitely puts me at odds with the street.
Well, if you weren't a little worried, I think I would be worried. Steve, listen, we've really appreciated your contributions over the course of the year. I look forward to doing it again next year. In the meantime, enjoy your break. Look forward to seeing you in the new year.
Thank you so much. Enjoy your break. And of course, again, most people here, their hearts go out to what happened in Sydney, this weekend. So hopefully next year's a lot better for everybody. And I'll see you then.
Absolutely. Thanks, Steve. Steve Sosnick from Interactive Brokers. Let's catch up on where we're likely to start. We're just less than a minute away. Looks as though we're going to start mildly negative. We'll get across that in just a moment. Stay with us.